Would you willingly hand a $35,000 penalty check directly to the government just for helping your own child buy their first home? Millions of generous parents do this exact thing every single year without ever realizing they have crossed into dangerous regulatory territory. They believe that handing over a private loan to protect their children from high interest rates is a completely invisible family gesture. It feels like a massive parental victory until a formal government notice arrives in the mailbox, demanding thousands of dollars in retroactive taxes. In a highly competitive housing market, where retail bank mortgage rates float near 7%, offering a 0.5% private loan seems incredibly smart. But what feels like pure altruism to you looks like a major tax avoidance red flag to highly sophisticated government tracking algorithms. By trying to shield your family from commercial banks, you might accidentally trigger an asymmetric audit that systematically drains your hard-earned retirement nest egg. To protect your assets, you must understand the invisible interest rate that regulatory systems legally force you to charge your own blood. The primary reason parents fall into this expensive situation is a psychological cognitive error known in behavioral economics as omission bias. We naturally believe that avoiding formal legal contracts with our family members is much safer than actively setting up strict financial agreements. However, the legal code does not care about family bonds or your kind intentions when high-value capital begins to move across accounts. Under these strict rules, any financial transfer between family members must carry an interest rate equal to the official, applicable federal rate. Think of the tax authority as a silent, automated digital filter that constantly monitors high-value transactions across the entire country. When a new home purchase is officially recorded, the county deed registry automatically logs the transaction into a centralized public database. If the algorithm detects a high-value property deed registered without any corresponding commercial mortgage, it instantly flags the buyer's annual tax return. The system immediately traces the origin of the funds, looking to see exactly how a young buyer secured such massive purchasing power. When investigators find an informal family loan set below the federally mandated rate, they legally calculate what is called imputed interest. This means you are legally taxed on interest income you never actually collected, paying real cash to the government for phantom earnings. Even worse, the remaining unpaid interest balance is instantly stripped of its tax-free gift status and subjected to heavy retroactive gift taxes. The only way to completely bypass this automated system is to understand the exact mechanics of compliant asset structuring and wealth preservation. Armed with the correct systemic financial intelligence, you can easily protect your hard-earned assets from these aggressive regulatory audits and costly mistakes. Every single week, we systematically dismantle the hidden wealth-draining setups that catch 90% of modern, high-earning households completely off guard. Subscribe to Economecha now and arm your family with the precise financial literacy required to grow, transfer, and preserve your legacy. To see exactly how much money is won or lost under these rules, let us examine two identical families with completely opposite strategies. Both households decide to finance their child's $500,000 home, but their choices lead to a massive divergence in wealth. Let us first track the sequence of Family A, who believes that absolute generosity is always the safest path for their children. They transfer exactly $500,000 directly to their son at 0% interest, relying entirely on a silent, informal handshake agreement. Within 24 months, the automated government audit system flags the son's tax file, instantly exposing the undocumented source of his home purchase funds. The government immediately applies the current federally mandated, long-term applicable federal rate of 4.5% to the outstanding principal balance. This calculation instantly generates an imputed interest of exactly $22,500 every single year, regardless of the family's original agreement. Over a 10-year period, the tax authority officially recharacterizes this uncharged interest balance as a taxable financial gift. Because this retroactive amount exceeds the annual tax-free gift exclusion limit, it triggers a massive, unexpected gift tax liability. the parents are suddenly slapped with a cumulative penalty invoice exceeding $45,000, while also paying income tax on phantom interest. Now, let us examine the strategic sequence of Family B, who prioritizes compliant wealth building and structural financial protection. Instead of a handshake, they draft a formal promissory note locked at the exact current midterm applicable federal rate of 4.2%. They officially register the private mortgage deed with their local county clerk's office and file a compliant Form 709. The son pays the interest directly to his parents, which is tax-deductible for him and taxed as standard interest income for them. No regulatory penalties are triggered, the asset transfer is 100% compliant, and the valuable interest payments stay inside the family circle. The difference is staggering. Family A pays thousands in penalties, while Family B keeps every single dollar within their personal ecosystem. To guarantee your family enjoys the same bulletproof protection, you must implement the precise four-step asset allocation standard starting today. First, locate the monthly federal rates by visiting the official government index and finding the exact term matching your loan. You must match your loan's duration to the corresponding federal bracket, ensuring you use the exact required percentage for your contract. Second, draft a legally binding promissory note that explicitly outlines the repayment schedule, the exact federal rate, and the property collateral. This binding document transforms a loose family agreement into a formal, structured debt contract that the regulatory systems must respect. Third, formally record the private mortgage with your local county recorder's office to legally secure the debt against the home. This crucial registration allows your child to legally deduct the interest payments on their annual individual tax filing without any risk. Fourth, document every single payment by setting up automated monthly bank transfers and keeping clean, undeniable electronic records of each transaction. Never rely on a simple handshake or verbal promise when navigating high-value capital transfers within your family circle. Tomorrow morning, visit the official index. Look up the current rate for your loan term and consult a professional estate attorney. Take complete control of your family assets, keep the tax authorities out of your living room, and preserve your legacy.